Alright, gives me great pleasure to now bring on board the CEO of Aditya Birla AMC, which is A Bala, a very dear friend of mine, and of course one of the most authoritative voice on mutual fund trends and which way markets are moving. Bala, so good to have you back. Thank you for joining us. Bala, the news for the mutual fund industry of late has not been very encouraging, especially on the flow front. Now, when the AMFI data came out last week, everyone thought that it's a one-off, which is that, look, nobody was able to redeem in the month of May and June, or in the month of April and May, and redemptions have come out in the month of June. Are things looking up the first 15 days into this month? Are you getting a sense that things have normalized, or July could be another month of outflows or no flows for the industry?
I think if you look at the trend of the last almost 6 months, one, we have been seeing a declining trend in terms of flows into equity, unlike what we have seen in the 2017 and 2018, 2019, where the peak inflows used to go as high as about 18-27 crores per month. That has been gradually declining. Second, if you also look at SIP as an asset class, while of course been growing, it's been holding firm or close to about 7,900 crores. That inflow of course comes. And if this pullback that we have seen in the market, from after seeing almost a fall of 30% fall in the month of March, where it took actually the entire investors' confidence, such a sharp fall I've never seen in the last number of years. So that fall took the investors' confidence, of course not confidence per se, but it did create some kind of panic among people that not so much of it has been made out of investments in equity. And as the bounce back came, we have seen some bit of profit booking that has come from a sort of investors, HNIs or institutional investors, or even to some extent, some of the people have been with the fund for the last say 5-6 years period. So that's a normal trend we have seen. And I would assume, given the current pullback that we have seen, and probably you'll see the trend continuing for some times. But that again, I would always call it as a phase of consolidation. It's a phase of some bit of what we normally see in terms of corrections. I think we have seen substantial growth the last 2-3 years. And we are seeing some bit of profit booking coming in as a result of that. Even in the month of July, I would say the number would remain somewhat a muted number as it is in the month of June. So I don't think the number will change significantly, given the fact that there is no incremental news that has been coming in, which actually boosts the confidence both for the economy as well as on company results per se. Except in areas where we have seen quite obvious that deployment opportunity today is so little. Hopefully that should actually keep the flows going post I think July August period.
So Bala, what should one expect then? I mean, should one expect that mutual funds are unlikely to be significant contributors, at least on the liquidity front, for next couple of months? Because the general psyche of retail investor is that they've not made money last couple of years in SIPs, so they're trying to redeem it. I mean, I don't subscribe to that policy, but that's how typically we've seen trends and cycles have moved. So do you think this slowdown in equity schemes or equity inflows, not for Birla, not for HDFC, but for the industry, is here to stay for the next 6 months?
I think the whole industry will probably see the equity asset class while it will go through some bit of consolidation phase at this point of time, where people see rebalancing of portfolios. I think if you can look at the way I think where the outflows have happened, but predominantly has come in the balance fund as a category, which is the most of the people who have come as alternate to fixed deposit or alternate to a conservative way of participating to the equity through the balance as a category. And we have seen some bit of outflows there. And second is, I think some bit of outflows happen in the large cap category. But given the fact that I think the overall the news flows, I think should turn positive as we move forward, coming from 2-3 angles. One, the interest rates are so low, and the banks have already started cutting the interest rates quite continuously. And the lending rates from banks' point of view, which was not coming down at least about 1 or 2 months back, that's now started coming down. And in fact, the month of June, interest rates have reached one of the lowest possible rates in the last number of years. The AAA companies are getting able money at about 5%, pure 5% for a 3-year period. And most of the banks, whether it is State Bank of India, HDFC Bank, most of the banks have now cut down their deposit rates. which essentially means it actually put a question mark in the minds of people that which is an asset class I should go and actually make an investment. And then you probably deep dive and start asking a question to yourself that which is an asset class will ultimately boil down to yield asset class. Therefore, the retail investor's point of view, there's one of the things that we of course keep harping, that while the inflows and outflows is a function of the sentiment that we have seen, but I think clearly, given the fact that the economy is being driven actually for the next round of pullback, probably the equity market will also start showing up in their return. Therefore, one should not actually take the trend that we have seen in the last 1 or 2 months and make an assumption and extrapolate it that will be the scenario as we move forward. And pay attention to the liquidity, pay attention to the low interest rates prevailing for considering investment in equity, apart from the gold-based investment opportunity that one may look at it.
Right. Bala, given the kind of, new retail participants which are jumping into the market, one is wondering as to what is the right mutual fund allocation for people who are stepping into the market right now, and especially, given the point that you were as well highlighting, with the interest rates now going lower and perhaps for the foreseeable future and God knows how long, you wonder what's the prospect of fixed income and debt funds as well. What to your mind should be the right allocation for people who are looking at fresh allocation in mutual funds for say the next 3 to 5 years?
Yeah, I think interesting, I think if you look at one is the interest rate and second is inflation, what is the investment alternative that one has got in front of them as of today, whether it is in fixed income or in equity or in real estate or in gold. Also keeping in mind the real rate of interest that one is able to generate in the current market condition, then naturally equity becomes an asset class to overrun at this point of time. While one can argue the current fundamentals of the economy is not justifying the current bullishness that they are being witnessed in the market, but clearly I think the way we see is the market will start estimating some of the outcomes that could come on the back of what the global central banks have done in terms of providing liquidity. The government has done in terms of pushing the fiscal stimulus, and even India too, I think we have done great work in terms of making the interest rate so low. Ultimately, it has to start reflecting on cost of capital for companies coming down as we move forward. So, therefore, and that being the case, one should probably go overweight in the market. Second is, given the fact that the ETF flows will start coming in from overseas investors, especially dollar-based investments could move away from US to the emerging market, and there is a widespread feeling that is coming for the next round of bull market could come in the emerging market, and given the fact the emerging market debt to GDP is still remains under control compared to the developed market, if that comes, naturally the money will move to the index funds or maybe the index or the large cap. Therefore, the asset allocation point of view, one has to take a mix of large cap and multi cap as part of the portfolio. Each of just going too much into the fixed income where the rate of return that will get at the end of say 6 months or 1 year, you realize my return has dropped about say 5.6% in fixed income schemes, given the fact that the rates are there. So the last of course if this is, if you look at the valuation of the market, I think the mid cap and small cap have gone down quite significantly. I think we are just doing some analysis. They are actually away by 50% from the earlier peak of the last 5 years peak that we have seen in the small and mid cap. They are still 50% low from the peak price we have seen in the last 5 years. And given the fact that I think the lot of steps will be taken to revive the economic growth, so that's also you'll see probably somewhat of signal will come. The small and mid cap also rising. Though I'm not suggesting that one should go and make the investment, but definitely the first time investors and those who have got exposure to equity less and should actually consider investing in large and mid cap, multi cap portfolio from an investment point of view.
Is there also perhaps merit in taking concentrated sectoral allocation to any of the sectoral funds at this juncture? We all know that pharma from a completely undervalued zone, just about 3 months back is really the sought after story in town. And maybe for the next long term as well, this could be an attractive bet, or for that matter, PSUs. And I don't know, many sectors you would know better. Would you think that could also be a prudent approach? Maybe take some allocation to some of the sectoral funds?
Yeah, I think the two things that we keep debating, of course, one, as you rightly mentioned, pharma fund, which has of course not done well the last say 5 years, done well in the last 1 year. Given the fact that so much of attention has come towards health and the pharma as a sector to nurture as we move forward, we'll probably see more and more incentives being given to the sector actually to spend money on R&D to be future ready from the medicinal innovations point of view. Therefore, that sector I think one should look at as part of the allocations. Second, of course, one of the sectors I think in the earlier section that you were talking about, banking finance for the sectors. Now in the last 3 years, absolutely no return has come. And the sector which is proximate to the economy, and also the sectors which participate in the overall growth when it comes back. And today the banking sectors in terms of valuations have come very attractive level, except that they are not of course growing their books given the fact that most of them are still conservative when it comes to the question of lending and go out to the market to lend and take risk, which will probably take some time. And today the valuations are available very cheap. Therefore, if somebody is taking a sectoral call in the next say 1 to 1.5 years or 2 year period, definitely I think banking finance of the sector seems to be a bet. So one doesn't need of course no need of course hurry up the investment, and I think one can closely watch the sectors for them to actually make investments as part of the sector allocations, the overall portfolio allocation that they have.
Okay. Bala, with the continued interest in a handful of those names in the market, there still seems to be a lack of conviction in the overall economic recovery. How would you apply that, let's say, to the consumption names? Would you still go for those driven by the recovery that's coming in on the rural front first? Would you still wait to see how the overall trend shapes up?
Yeah, I think it's interesting. I think look at the consumption as a sector. I think multiple cycles, irrespective of whatever happens, economic growth, irrespective of whatever happens to the broad policy framework that has been set out by both government and Reserve Bank of India. I think consumption sectors continue to remain the sector to watch out, given the fact that rural economy today is doing all right, and in fact the good monsoon which currently we are witnessing, we will probably see the more interest coming from the rural sector in terms of growth. And second, whatever the government has done in terms of the social benefits being given to the rural sector, probably will see increased activities toward that segment in terms of reviving the first economic growth in rural India, then comes to urban consumption to power. So keeping this in mind, I think consumption as a theme, which I think will remain in terms of investment opportunity. Even from money manager's point of view, the sector cannot be ignored, given the fact that the balance sheets are good corporate governance, products that are being sold, ultimately it will have some kind of interest coming from the consumers. Therefore, sales currently we are seeing down temporarily, would also come back with some kind of pent-up demand going up. So that sector I think one has to look at as part of the portfolio. And having seen outperformance for the last almost 3-4 years, it's done a very good outperformance. And this sector always go through some kind of PE correction. The earnings will be good, but the market may not go up, it recognize, and so on and so forth. That cycle in which we go through. But of course, if you look at the longer term period, they hold the high potential of giving the compound annual growth of return in excess of the cost of capital.
Okay, so that's on the consumption side then. Anything else that you would want to include, Bala? Let's say financials and consumption still take up a large part. Where else would you perhaps venture in, take a bit of a risk, with the expectation of higher returns? Should we see that turnaround coming in, let's say, within a year or so?
So one thing, the telecom industry is on its way of revival. And we have seen this in the last 1 year. There is one sector during the lockdown period too have remained insulated from the earnings point of view. I think that's one area where we will continue to see we have pulled back and interest coming in from the money manager's point of view. I think that's where even allocations are now being done towards the telecom sectors. And second, one has to of course keep a close watch on the capital goods sectors, depending upon how the government is going to push the spending in terms of infrastructure building. We'll probably see some bit of revival in the capital goods sectors coming back as we move forward. So these are the sectors which are again beaten down. I think the growth prospects have got reduced quite significantly. And given the fact that the push is being given to drive the economic growth next levels, both India as well as globally, you will see the capital goods sector is also coming back with some bit of lag. The last, of course, is in the power sector, which has remained under stress for too longer period. Both the power transmission company and power producer company, especially transmission companies, have got a stable revenue, and there is absolutely no risk from the overall business point of view. And therefore, that's also another sector, or small sector, not too much of representation which is there. And the again bigger sector which you need, of course, watch out in terms of growth prospects improving is on the auto sectors. It's very mixed feeling that is coming in. But naturally, one has to, of course, keep a close watch on how the sales numbers are going to pick up, starting from two-wheeler and then the passenger cars, and then move on to the trucks. There are no indication at this point of time that sectors could see a big significant revival except two-wheeler. That's also a sector which has got huge potential to revive economic growth, subject of course government is giving some special push to that.
Bala, the bottom line here is that, and I'm asking you a great question, that economy is not in a good shape. Earnings are unlikely to come and markets have run up. So if somebody says that, look, if I'm starting my journey of equity investing or I'm already on my journey of equity investing, how can I make money? Because entry price is a function of returns, and if entry price at the current juncture is not great, how does one figure out future returns?
It's interesting, Nico, and I think look at the argument that currently is going towards investing in equity, clearly coming to the fact that one is liquidity is very, very high. Global, I think, we are seeing unprecedented liquidity that has come into the system. First time we are seeing it after a very, very long period of time. And second is the way I think interest rates have been brought down so sharply. Ultimately, that liquidity has to find its way to the market. Earnings are really the function of economic recovery growth. First, the market rallies initially on the hope and expectations, and also an alternate to the high liquidity that's there in the systems. Then the earnings come back. So that being the case, if somebody wants to just look for a confirmation of the earnings coming back, economic growth coming back, and then on the basis of the earnings coming back, therefore only after they start making investments, clearly they will probably miss out the first 10 to 20% of the rally, which otherwise is quite significant from the investor's point of view. So that's one of the reasons why we always keep saying that while one can have an argument of this kind and continues so well, but given the fact that I'm investing money for say 10 years, 14-year period, such kind of trying to time the market may not actually lead in a significant outcome for the investors. So that's I think one has to keep in mind. The market, as I mentioned, the earnings follows the economic recovery, and economic recovery is supported by a portion of the equity market, and then that's the cycle in which I think most of the market moves. So that being the case, my view is while one, as I mentioned, the potential value is there in the mind of people, but one has to look at the whole cycle and take into account and make this investment consideration on that portfolio.
So Bala, let's get closing comments going. If you have to, let's say for next 5 years, choose between a small cap, mid cap or a multi-cap fund, which is the best way out?
I think 5 years one takes it, probably I would even take a bet mid and small cap, given the fact that today they are trading at the lowest possible rate, and though the recently has given a bounce back, and given the fact that that's the segment in which where significant alpha could come, if somebody has got risky money and a 5 year plus time frame, it definitely makes sense to take a bet on mid and small cap funds. Having said that, multi-cap, I'm not saying that one should not look at it, but within these three asset classes, a multi-cap and small cap and mid-cap, maybe 30-40% could go to the multi-cap and balance can go to the mid and small cap funds.
All right, Bala, we'll leave it there this morning. Thanks so much for joining us and taking us through your view on things as they currently stand. All right. Let's also get into a conversation now on the kind of flows that we're seeing currently. We've got investors